So, today I want to talk to you about how to invest like the best. How do we use a smart, evidence based approach to something that is very complicated and, quite honestly, scares a lot of people? There are thousands of stocks, thousands of mutual funds out there. In fact, there are over 4,000 publicly traded stocks in the US alone, and there are tens of thousands of different mutual funds to choose from. And usually, when we talk about investing, people equate that with stocks. And certainly, stocks are part of investing, but it is not the only thing that you can invest in. You can invest in bonds and precious metals and real estate and options, etc. But for today, we're going to talk specifically about stocks and what's the best approach. What is the best way to invest in stocks, to choose stocks? And today, I'm going to sort of make the case for something that we know generally as factor-based investing, or sometimes people refer to it as evidence-based investing. But before we dive in, please note that all the information that we're going to share on this podcast is for educational, for informational purposes only. This is not intended as investment advice. I would always strongly recommend consult with a professional financial planner before you make any investment decisions, because every investment has risk, and it's important for you to make informed choices that are based on your personal financial situation. Now, before I can even begin to explain what factor investing is, what I really need to do first is just explain the two prevailing methods. And that would be active versus passive. You may have heard these terms before: active investing, passive investing. I'm going to do that first, and then I'm going to explain how factor investing sits somewhere in the middle of those two. So let's start with active investing. This is what most people think of when they think of investing in mutual funds or in the stock market. Active investing is kind of like hiring a professional chef to cook for you. Let's pretend that you want to make a really fancy meal, something that's going to knock people's socks off, be very memorable, but you may be a little bit intimidated by that process because you're not sure what ingredients to buy, you're not sure how to put it all together and how long it needs to be in the oven and all. So instead of doing it yourself, what you do is you hire a skilled chef, and they're going to be the ones that pick the ingredients and combine them perfectly and time everything just right and know how to even set the display for the table. And the active manager, an active fund manager, is kind of like that chef. When you're handing over the responsibility of managing your investments and choosing what's what to someone who's an expert. They're going to do the research. They're going to make the decisions about what to invest in and when to adjust things based on what's happening in the market. And the idea is, well, they're specialists. They should be better at making these decisions than I could, or just using some random approach. So what you're doing is you're paying them for their expertise and hoping, of course, that pays off. And what an active fund manager is going to do, their main goal is to outperform the market average. So let's say you have a stock fund manager who invests in large U.S. stocks. What do they want to do? Well, they want to beat the market average, like the S&P 500 index, because that just measures the average return of the 500 largest stocks in the U.S. So if the S&P 500 does 10%, they want to be above 10%. And they're going to do that by carefully selecting which investments to have and which ones not to have and when to make changes. So they're going to do all the research and the analysis. They're going to study the markets and the earnings statements and the economic trends, and then they're going to select the investments. They're going to choose, hey, we're going to have these companies and we're not going to have these, based on all of their research and their opinions on what's going to do well. And then they're going to manage that portfolio. They're going to decide, okay, if we're going to hold these 80 stocks, well, what percentage? How much do we have in each one of them? And then they're going to monitor that. They're going to adjust it. They're going to constantly be changing because, well, maybe one of their companies did really well, and so they're going to actually sell part of their holdings in that company, or they spot another opportunity over here, and so they're going to buy this company, or they're going to get rid of this other one. And what's happening is, of course, the active manager, they're not doing this for free. They charge a fee for their management, and they just deduct that directly from that pool of money. So all these people have mutually funded, that's where we get the term mutual fund, have mutually put their money into this fund. And so in that pool of money, most of it is going into these different investments that are being selected, but some of it is being deducted on a regular basis for the management, the professional management of that fund. So they not only need to beat the market average of whatever type of stocks they're investing in, but they also need to beat the market plus whatever their management fee is in order to actually be making money in excess of the market for their investors. So I'm going to use an analogy across these three different types of investing, and hopefully this will make more sense. So let's think of a fishing competition. So imagine you're on a lake with hundreds of other fishermen, and of course the goal is to catch the biggest or the most fish. And so the active investor, let's picture them as the person who's constantly moving the boat around the lake. They're searching for the best fishing spots, and they're trying to outsmart the other fishermen by finding maybe the hidden places where the best fish are and where other fishermen are not going. And it's like picking stocks. It's like trying to time the market based on their research or their intuition or predictions. And the active investor is also going to have all the gear. They're going to use special bait and have different types of advanced gear or different techniques because they want to be able to try different strategies depending on what they think the situation calls for. And so everyone else on the lake, of course, is looking for the best spots, and they're using similar tools and strategy. So because there's a lot of competition and because there's a lot of people doing the same thing, it gets really hard to consistently outperform. Maybe once or twice you might be able to, but on a regular basis, using this method gets really, really hard to do consistently. And because you're moving around a lot, because you're buying all the top of the line equipment, it means more effort, it means more time, and it means more money. That's why active investing involves typically higher fees and expenses and movement compared to other strategies like passive investing, which we're going to talk about here in just a second. So what typically happens with active investing is, yes, sometimes you catch the big fish, sometimes you have a great day, and sometimes you don't. Sometimes that's because of luck or competition or the conditions, and all of those things are unpredictable. On average, about 90 to 95% of active managers do not beat the market average. They underperform their index. And that's when we look at longer time frames. Now, in any given year, it might be about 50% or even more of active managers that beat their average. But when you start looking at longer time frames, 3, 5, 10, 15, 20, what you're going to see is each longer time interval, the more active fund managers drop off. And many of them don't even survive that long. They might only last 8, 9, 10 years and then drop off because they go out of existence because there's not enough people investing in that particular fund. Now, why is it? Why do most active managers underperform the benchmark? Well, there's a lot of reasons for this. First of all, like I talked about, there are higher fees, higher expenses. Because the active funds are charging a higher fee for their management, that means they're creating that much more of an obstacle or a barrier for them to have to overperform, compared to some of these other strategies that we're going to talk about here in a second. Also, because they're doing a lot more trading internally within their funds, well, every time they make trades, there's a small cost for those trades. And so that can add up over time. Another big reason, though, is just market efficiency. 50, 60 years ago, it was a lot easier to have maybe a leg up on the market, to have inside information or to have a little bit better information or systems than your competitors. But now, with all the algorithms and AI and market information, so much of market prices are already priced in. It's really, really becoming more and more difficult with every passing year to have any sort of competitive advantage. Most information is already priced into stocks, and those things move very, very quickly. So it's hard for active managers to find good opportunities that other people have not already identified. And then also just overcrowding of the strategies. So a lot of these active managers are using kind of the same tactics. So to go back to our fishing analogy, it's kind of like, well, if you think, hey, I'm going to use this special type of bait, that's really, really helped me today. Well, it turns out, 20% of the other people out there on the lake have already, they're already in on that strategy. They're already using that type of bait or that, or that technique that you're going to try out. So in other words, the things that you think are going to set you apart in the active space, there's actually a lot more people out there than you realize doing the same thing. And then also short-term focus, just like the active manager, the guy out on the lake who's constantly moving to new spots. He tries a spot for 5 minutes. Oh, no bites here. I'm going to go to another spot. When you focus on short-term performance, that can also lead to poor decisions, such as trying to chase a trend or making a speculative bet. It's just really, really hard to time the market. And we've seen this time and time again. So on one end, you have active investing, but let's go to the other end and let's talk about passive investing for a second. What is that exactly? Well, passive investing is a strategy where the goal is just basically to match the performance of the market average. You're not trying to outperform it, you're just trying to get whatever the market's going to give you. And so what you typically do is you invest in an index like the S&P 500. So instead of saying, I'm going to try to find the large US stocks that I think are going to do better and figure out which ones are going to do worse and hold the ones that are going to do better and not hold the ones that are going to do worse, you just say, I'm going to own them all. I'm going to own all 500 in exactly the proportion that they are at this, based on their company size, and I'm just going to let it do its thing. And whatever those 500 companies return will be my return. So they don't try to actively buy and sell individual stocks. They don't try to time the market. Instead, they just hold all the companies that mirror the index and just let the market do what it does over time. And the reason that this strategy has become very popular, by the way, 50, 60 years ago, almost nobody did this. This was a very foreign concept. Vanguard was really the pioneer of the passive investing. And of course, Vanguard has become very, very successful and is used very, very widely. But, not all that long ago, hardly anybody used this approach. But over time, what we found is that it's a great approach and almost always beats the active approach for a few reasons. Well, first of all, it is much lower cost. And it doesn't require a lot of effort to maintain. There's not too much to do. And it really avoids the risks, and that's a really key thing, of frequent trading and of market timing. So again, we're not trying to outperform the market. We're just trying to mirror what the market's doing. And because there's really not much to do with these funds, it's not like there's not too much management to do. It can be a pretty automated process. The expenses for these funds tend to be very, very low, a few hundredths of a percent being deducted. Okay, so here's how this works. So if we want to go back to our fishing analogy here, the active investors got the boat, got all the gear, they're constantly moving around, constantly trying different techniques because they're trying to get a leg up on the competition. The passive investor is like the guy who just goes to the popular area of the lake where they know there's a steady supply of fish and where people usually do pretty well, and doesn't really overthink it, just gets some simple gear and just stays in that spot all day. It's kind of like investing in an index fund. You don't move around a lot, you find a good spot, and you just let time work in your favor. Not try to outsmart others. You're not even necessarily trying to chase the biggest fish. You're just trying to put yourself in a position where you know this is going to yield pretty consistent returns and probably, more than likely over the long term, is going to do better than hopping around, right? And again, you're using simple tools. It's not very complicated. It's not very expensive. And it's really about patience. So, and also you're not concerned about the other fishermen out there. This is not about trying to outperform them. This is not about trying to compete with them. This is just about letting the lake and letting the fish come to you, so to speak. And over time, by keeping things simple and steady, maybe you don't win. You don't expect to win a lot of flashy fishing trophies, but you're probably going to catch more fish and do better than most of these other guys with far less effort, stress, and cost. So between those two strategies, in the real world, the passive investing wins out the vast majority of the time. And again, maybe in the show notes, I'll include a link. Actually, I'll do that. In the show notes, I'll include a link to the Spiva reports S&P 500 index versus active. And it has a great breakdown of how most active funds don't beat their market average. But you say, okay, that was a long intro with a lot of information there. But now I want to get to the real key part of this podcast, which is what is factor investing and how is it different than those two? Is there any in between? Well, is there any way you say, okay, between the two, I mean, there's got to be like a happy medium, right? Can we avoid the downsides of active management, but also be a little bit more strategic than the passive investor? So that's where the factor-based investing comes in. So what is factor-based investing? Well, what it does is it focuses on specific drivers of return, known as factors. There are certain characteristics that academic research has shown outperform over a long period of time. There are lots of factors out there that you could invest in. There are really just 5 that I would say you could narrow it down to that have strong, consistent academic research behind it that shows that these are worthwhile factors to invest in. There's, to be clear, there is certainly debate over these 5 factors. Should it be these 5? Are there only 3? Are there 4? But I would say, really, you would be hard-pressed to prove conclusively that there are more than 5. But these are kind of the 5 most generally recognized factors. Value, and that means stocks that are priced lower relative to what their fundamentals would show, like their earnings, their actual book value. You look at the price of the stock and you say that seems low compared to what that company should be worth on paper. Stocks that are smaller size stocks, generally companies that are less than $10 billion. They have a higher growth potential. Over the long term, value stocks that are lower priced, tend to do better. Smaller stocks, smaller sized companies tend to do better. Profitability. Higher profitability companies tend to do better than lower profitability companies. Momentum. Companies that have recently performed well do often continue to do well and to do a little bit better than their counterparts. And then low volatility. Stocks that their swings in value are less than what maybe the average stock might swing in value up and down. They have more stable prices over time. Now, again, there's so much. We could have a whole episode on every single one of those factors. I just can't go into great detail on each one of those factors, but I did want to mention those 5. How does this work in practice? So you say, okay, the academic research has shown, by the way, these factors have outperformed in the US, but across the world. It's not just the US stock market, it's all stock markets. And it's not just recently. It's not just, the last 30 or 40 years. This is going back decades and decades and decades. Essentially, what the academic research has done is they've gone back through all the known data for stocks and said, what are the things that work all the time, consistently, over long periods of time, no matter where you look? These are the 5, essentially. And so how would a factor fund work? Well, they would start with what the passive fund does. Like, let's say you want to have a factor fund that invests in large US stocks. Well, what you do is you would start with, let's say, the S&P 500, the 500 largest. So we're going to start, here are our 500 largest stocks. We're going to assemble them all together in front of us. And then we're going to take our factor or factors. Some funds just operate on one. They only use value or they only use momentum. Some use multiple. They say we're looking for value and size and profitability. But they take those factors and then they screen all those companies. So they have different metrics that they're looking for, okay? We're looking for value companies. We're looking for small companies. We're looking for high profitability companies. So they screen all of those companies and put them up to those tests and find, okay, which ones have those factors and which ones don't. And the ones that don't have those factors, what they'll do is they'll say, okay, we're going to hold less of that company. Or maybe we're going to eliminate it altogether. We're not even going to hold that one. And then the ones that do have those factors, hey, we're going to actually dial up our percentage. A great way to think of this is kind of like an ice tray. So what a passive fund does is it says, here are all the stocks, and it pours the water. You know, like the old school, like ice trays. I know most freezers, they have the built-in ice tray now. But, remember doing that? You fill up the ice tray with water and stick it in the freezer and make ice cubes the old-fashioned way. So imagine taking that ice tray, filling it with water, and each compartment has the same amount of water. Well, that's what a passive fund does. But the factor-based fund is what they're going to do is they're going to tilt that ice tray and let some of that water flow more into some of those buckets and have less water in others. That's essentially what we're doing. So as an example, let's say you start with the S&P 500. Well, in the S&P 500, 7% of your money, or around there, is going to be an Apple, and 4% is going to be an Amazon. But maybe after you use those factors and you screen it out, you find, actually, Apple doesn't have the factors that we're looking for, so we're going to dial down how much we have in Apple. Instead of having 7%, maybe we'll only have 5.5% in Apple. We'll still have some, but just not as much as it would represent in the market otherwise. But maybe Amazon does have the factors that you do like, and so we're going to dial up our percentage. We're going to have 5% in Amazon instead of 4%. Do you see what I'm saying? And what you're going to do is you're going to monitor and adjust that continually, because those those metrics that you're using to figure out, is a stock a value stock or a small stock, that could change over time depending on how that company does. And if a company all of a sudden no longer fits those criteria, you may want to change how much you hold or whether you even hold it at all. All right. So there's going to be more changes in those portfolios, but it's going to be rules based. It's not going to be based off of intuition or a gut feeling. Now, as far as costs, factor-based funds will be a little bit higher in cost than passive funds, but still markedly lower than most active funds. So just like they sit in between those two in their style, they also sit in between the two in their cost. Now, performance. Okay, there is no guarantee, so I certainly don't want to come out here and say, yes, invest in factor-based funds and you'll definitely do better. But of the factor funds that I've researched and of the ones that I've used, looking at their performance compared to similar passive funds, most of them have done better over the long term. But there have certainly been windows, seasons of time in the short term where they've underperformed along the way. So the best way to evaluate a fund and how well it does is to look at long periods of time, 15, 20 years and beyond, because 1 or 3 or 5 years really doesn't tell you much of consequence when it comes to investing. So to go back to our fishing analogy here for a second, all right? The factor investing is like somewhere between the active and passive. It's like choosing your fishing spot based on scientific research about where and how the best fish are likely to be caught. It's a middle ground, okay? So, instead of randomly searching the lake or just picking a popular spot and staying there, what you do is you analyze the data about the lake. You look at the patterns. Where do fish tend to gather? You look at things like water temperature and depth and time of day. And then you target those things accordingly. And what you're going to do is you're going to find a spot, and you might move occasionally, but only if the data strongly suggests that a better spot would be appropriate at that time. So you're not chasing a rumor, you're not chasing a gut feeling, but you're also not sitting in one spot the whole time. And so it's a rules-based type of philosophy that allows for a little bit of adaptability. So you do put in more effort than passive fishing, okay? But you don't exhaust yourself constantly like the active fisherman. And over the long term, by fishing where the data suggests you're going to get the best results, if you stay consistent with that approach, you're probably going to do better over time. You're probably going to catch more fish, and you're not going to have as much stress about competing aggressively or trying to rely on good luck. So factor investing, what it tries to do is get higher than average returns by focusing on those factors that have been proven over time and trying to keep costs relatively low compared to active managing. So it's trying to give you the best of both worlds, essentially, is the way we want to think of it. Now, of course, what's the benefit? The benefit is if you use this strategy and stick to it, you have higher potential returns because, again, things like value and small size and high profitability, they've been shown. They consistently outperform the market over long periods. So if you're willing to, kind of quote unquote go against the crowd, you do gain the possibility of increasing your returns. But there are some challenges, and I don't want to overlook these. What are challenges to factor investing? Well, first of all, one of them is the complexity. And this is the reason I'm doing this episode today, because I think it can be a little bit of a daunting topic. It kind of feel like it goes over your head a little bit. And so it seems intimidating. So therefore, people don't want to try it because they're not sure if they understand it. But also the underperformance. Because remember, basically every time you look at a factor strategy, there are periods of time where it really does underperform. Like for instance, if you're comparing a factor portfolio to like the S&P 500, there could be 5 years in a row where it underperforms the S&P 500. And that's difficult. It's hard to stay patient as an investor if you're comparing to something that has been doing well recently. But that's also a big reason why the factors work. It's because they require patience and consistency that very few investors actually practice. Another obstacle, or I guess challenge we could say, to factor investing would be a little bit higher costs, a little bit higher fund ratios, expense ratios in the funds. Maybe what I've seen is generally maybe 0.2 to 0.3% compared to a few hundredths of a percent for index funds, but certainly way lower than most active funds. You are doing a little bit more trading inside of those funds, so that can incur a little bit more costs. There's a chance of overcrowding if a lot of people are trying to chase the same factor. But again, because a lot of these companies, there's a reason why people are staying away from them. If you're patient, most investors don't stick with those companies for the long term, and that's again why the strategy has worked so well in the past. And then the last risk I would highlight here is just sort of the back testing or confirmation bias. Just because factors have worked every time in the past still is no guarantee that it's going to work in the future. There is no guarantee. We don't know exactly how it's going to play out. But best we know, on all the available data, on all available research, it would seem to indicate that it will continue in the future. But again, there is no guarantee there. So bottom line here, factor investing, what it does is it gives you as an investor a structured and a disciplined way to chase those higher returns, but also to manage risk more effectively. By focusing on what's been proven to work instead of short-term news or swings in the market, you as an investor can potentially get that better overall return and really also at the same time minimize any emotional or speculative decision making. So if you'd like to learn more about factor investing, how we manage clients' money at Financial Pathway, you can always visit nateskelly.com or shoot me an email at info@nateskelly.com to schedule an intro call and learn more. But thanks, as always, for listening to the podcast. Hope this was a helpful episode to you. And we've got an interview podcast coming up next week. I'm looking forward to sharing that with you. All right, we'll see you on the next episode.